All right, everybody. This is Bootcamp with James, and this is going to be about the basics of spreads. What is a spread? How do you trade it? How do you do it? And also how to do it in Thinkorswim and Tasty. So I will do my best to fit this all in a 1 hour session, but I cannot guarantee it. All right. Do you happen to record your lessons on options for features? No, Mario, I did not record that, but I will do a lesson on it maybe tomorrow. It's almost as similar as everything we're going to go through right now. Recording, yes. Okay. I like Archfix, Tasty Words of the Beast. Yes, they are. Marco, blah, blah, blah. Okay, so here we go. Let's try to go through some things before questions get popped up. Save your questions, and I'll ask for questions after every time I do get through a section or something. Okay. So, what is a spread? A spread is pretty much an option with more than one leg, and by that means you have like the 235 strike and a 234 strike. That's a spread. You're doing more than one leg. Okay. Sorry, something. Now. So, and a spread can be anything from just two position, two. I'm going to show you on Tasty because it drives me insane. So, a spread, this computer's killing me, can be anything from just two positions to 3 to 4. It doesn't matter how many, as long as there's more than one strike selected, it's considered a spread. Okay? So that's just basically what a spread is. You have your long option, which would be something like this, long or short, and a spread is more than one leg. Okay. Now, what is a credit spread? A credit spread, back up. There's actually two types of spreads. There's a debit spread and a credit spread, meaning you're either going to pay for it or receive a credit up front. We'll go over the credit spreads first because that is mainly what I do. I do trade debit spreads, but credit is the one I do the most. So what is a credit spread? A credit spread is pretty much you're either short the call side or the put side, and you're shorting the more expensive leg in order to get the premium after you hedge it or define your risk with buying the other long side further out of the money. Okay. So a credit spread, we'll use Tasty for example. A credit spread is selling one out of the money and buying one further out of the money. And so, sorry, hold on. Email just came through. I gotta get. Why would go out tomorrow? Sorry about that. Okay. All right. Credit spreads, credit. Okay, so by getting a credit, the more I'm pointing at the screen like you can see me. I use the mouse. You're gonna sell one strike right out of the money, and that's gonna give a large credit. You can see, you'd receive $13. So you're shorting it. I'm gonna back up here. Short one of them, right? So you're selling an option. That's all you're doing. Sell a naked option. Okay? And you're going to receive a credit for that. Now, then you hedge it on the other side, right? And that creates your first basic credit spread because the long option is less expensive as the short option. You still get a net credit, as you can see down here. So if you short one side, you buy another. That's what creates the credit, and you're receiving money up front for this trade. While it's going to still hold hold your buying power, because as you could see, like doing this trade, it costs 377, so your max loss. So it's going to hold that as your buying power, but you're receiving 125 up front per contract that you do. Okay, so that's a credit spread, and that's anything. There's different types of spreads, and I'll get to that in a minute. But that's what a credit spread is. Now it's a credit spread. They can be directional, or they can be neutral on the underlying option or underlying stock. Excuse me. And what I mean by that is if you're bullish or bearish, or if you just think it's going to go sideways, that's what they're good for. So a credit spread profits over time. So theta in this case is your friend. You want the decay to happen, because that's where you make your money. As these options out of the money here start to decay over time, then they're going to be worth less, and then you buy back the option for a lower price, and that's how you make your money. Okay, now likewise, a debit spread is the same thing, and that would be you're paying for it. So you'd buy one option in the money or at the money and sell one further out of the money, and that's going to make it a debit. And the same thing, it's all defined trades, but you're paying up front. You don't receive any money up front. Okay, so that's the two types of spreads, meaning you pay for one or receive credit. Now there are also how do I even say that one? Just the types of credit spreads you have are the exact same as the types of debit spreads that you have. So you have like the ones I was just showing on here, which is the basic spread, is a vertical spread. Okay. Then you have an iron condor. You have straddles and strangles, butterflies, ratio spreads, calendars. There's a whole bunch you can do, but I don't do that many. Okay, I stay basic, I stay simple, and I only do probably about 4 different types, with occasional other one at that. Okay, let me check my list. Anyone got any questions so far? Okay, good question, Mike. No, because when you're buying only one option, then regardless, like you buy the call side or you buy the put side, technically you're still going long on that side. Granted, buying a put gives you this, synthetically way of going short on a stock. That is not what I mean when I say short the option. So shorting it is actually selling, selling to open, just like you would a stock that you think's going down. You're going to short it and then cover the position when you got your profit, or if you're upside down. That's the same thing. So going short on an option would just be doing the sell to open first. So this right here, as you see, sell, this would technically be being short a put, and then you buy the put to hedge the position. Okay, so that it's defined and you're not undefined anymore. Did I make any sense on that one? I hope I did. Okay. All right. Next. So, all right. Examples of this credit spread and how do you make your money? right? And like I was saying, they're directional based and not directional based. So if you're selling a put and buying a put, so you're selling a put, buying a put. Correct. But that's just on the put side. You could do the same thing on the call side. So say you are long the underlying stock. You think, in this case I have Tesla up here. You think Tesla's going to go up. It's the opposite on a credit spread. So if you thought Tesla was going to go up, you would actually short the put side. Okay, you could see here this green bar. That just shows you the direction. And I can go over here. This might actually help. Okay, as the stock goes up, you make money. Okay, so if you thought Tesla was going to go down, you would short the call side, and then by that I just mean you're doing a credit spread. Okay, and by shorting the call side, you're hoping that Tesla will go down. So on a credit spread, it's always the opposite end of what you're expecting it to do. Normally, if you thought the stock would go down, you would buy a put. Likewise, you'd buy a call if you thought it would go up. In this case, on this particular one, guys, I'm busy. What's
Daddy,
up?
I got 1,000 on the ball game. I got 1,000 on the ball game.
Okay, I'm making a recording. Go play. Sorry, kids, home. So the different kinds of spreads. I'll get in that because we'll get too far and you'll get a little confused. The basic credit spread is going to be a vertical spread, and that's either going to be the call side or the put side. So like I was just saying, if you thought Tesla might go down some more, you would place a vertical credit spread on the call side, because then you're short the calls and you think it's going to go down. Okay, likewise, if you thought Tesla was going to go up, you would short the put side, meaning you just put a credit spread on the puts. Yes, exactly. You sell a call credit spread is the same thing as buying just one long put option. But it costs like half the price. I mean, you look at this right here. If you're buying or shorting the call side here, my max profit, because it's a defined risk trade, would only be $153, right? So I only putting up $347. Likewise, if I was just to go long on the put side, thinking it would go down, I would probably place somewhere here. It's going to cost $2,000 to make the same trade. So by just defining it over here, you're going to make less, but you're putting up way, way less. And I'm going to make money over time, no matter which direction the stock goes up to a certain spot, versus if you're just long, you're negative as soon as it passes over. Debit spreads are more directional based, because you gotta be more at the money, in the money, and then know that it's going up. Whereas a credit spread, you're out of the money and you're just gonna make money over time. What broker does a broker usually require for what requirements does a broker usually require for doing spreads? Well, you need to have margin, Jonathan. And then you need probably level 3 on your options approval at the very minimum. Level 4 will get you to do strangles. Okay, but if you're just doing like a straight vertical spread, like anything that's defined, you can get away with level 3, I believe. The undefined trades, which I'll get to in a little bit here, are you're selling naked, so you're going to need, I think, level 4 on that. Okay, that's another good question, Joseph. I'll get to that as soon as I finish this part. So the basic spread, like if you were long an option, you wanted to be long the underlying, you're going to do a put spread. Okay. Now you want to do these out of the money. That way they decay faster. You don't want to do a credit spread in the money. You have a chance of being assigned on your short strike. Okay. Two, out of the money decay faster than in the money and at the money. So you want to be out of the money when you do a credit spread. And over time, like I said, the theta is going to kick in, and that's where you're going to make your money. Now, well, the reason I like these little more is, one, they're obviously defined risk, but you don't have to be right. If you can see here on this, you see the green line, that's the profit area, right, by expiration date. So Tesla's trading, we'll just use the example, 268 right now. But I'm out of the money here. So while I'm still directionally based that this stock will go up, guys, sorry, kids are so loud. While I still think that this stock will go up, I could be wrong 30 points here. Oh my God. And still be profitable on this trade. Okay. Here we go. Oh, I got a position open. There we go. Okay. So as you can see, I'll use this is probably a little bit easier for you to understand here. Vertical spread out of the money. Okay. Stock is trading right here at 268. While the verticals are directional trades, when you want to go up to make your profit, you can also be wrong and have it go against you, all the way up to your short strike, and by expiration date, you'd still make max profit. Okay, or likewise, it could just trade sideways 265, 275 for the next 30 days, and you're still going to make max profit. Okay, that's one of the advantages on a credit spread. When you're out of the money, you do not have to be 100% right. Okay. When you go long an option, you pretty much got a 50-50 chance. It's going to go up, it's going to go down. I can kind of care less as long as it doesn't touch my short strike. So that's how you would do and deal with a vertical spread. Now the next one that you have is probably the next simplest one that everyone's heard about, is iron condors. And all the thing is with iron condor is you're shorting both sides of the trade. So on an iron condor, you have your put vertical spread on the call side, and then you have your put vertical spread on the put side. And then that creates a range that you want it to stay within by expiration date to make max profit. I'm sorry, I'm in a stock that's trading after hours, so that's why I keep looking up. I'm monitoring that. So what does that look like? Okay, you're out of the money on the put side. If you thought Tesla, okay, we'll back up. An iron condor is a neutral strategy, meaning that if you just thought it's going to trade within this range for the next 30 days, that's what you want. If you just don't think it's going to go up or down dramatically, then that's what you want to do with an iron condor. So another example here, we'll just throw it on my 10 line. Okay, so an iron condor is just the same vertical spread on both sides. So as you can see here, you have a put vertical spread and a call vertical spread. And then what that does is, as long as the stock trades within your short strikes, you'll make the max profit by expiration. Okay? So those are the two most simplest trades on credit spreads. And probably the 90% of the time, that's what I'm doing. Now, there are other ones that I do, but they are not defined. And by defined, I just mean you have a max profit and a max loss. Okay, you won't lose any more than that. But one of the other ones that I do are strangles, and that's just the iron condor without buying the wings, and that's just shorting both sides. You want to do the same thing as an iron condor, stay in between your strikes, but this is undefined. You have no max loss. Okay? Those are the 3 credit spreads that I do the most. There are like ratio spreads, 2-to-1 type thing, or shorting the call side but then buying a vertical on the other. But those are a little bit more advanced, and that's probably a different boot camp lesson. Just trying to get you guys the basics here. The 3 types that I do are the vertical spreads, the iron condors, and the strangles. But we're just going to stick with vertical spreads right now. Okay? So that's how you make your money. Over time, because theta kicks in, and as your options that are out of the money decay, the price goes down, you keep the money, and you just want to buy it back at a lower price than what you received the credit on. Okay, and that's how you make your money. So a debit spread, it's all the same thing. You do the same things on it, but on a debit spread, you want to actually buy in the money and then sell out of the money. Okay, a debit spread's more of like a 50-50 chance. And you want to be a lot more directionally inclined on this one to make your money off of. You want to try to risk one to make one on that. So as this moves up, you make your money. Okay, it's just kind of like going long a little bit, but you're defining. Where was I? Defining your risk a little bit. Okay. I'll get into that too a little bit later. I don't do a lot of debit spreads right now, but that ultimately is a debit spread, okay? Let's see. Let's check questions. Chad, I normally on credits, well, not on credit spreads, but on defined risk trades, these vertical spreads or an iron condor, I really don't have like a stop loss on it. Whatever I go in at, I'm willing to lose. Okay. However, depending on the price of the option, if I'm down $100, I'll start to look and see. Like $100 loss is kind of like, okay, I need to evaluate this trade. But there's a lot of things that go in to me deciding if I'm going to get out of the trade or let it play out. Okay? How do you scan? Do you ever split your trades? Jeffrey, no, I don't leg in or leg out. I buy or I sell. Edwin, that'll go with the next question. Mario, yeah, I'm typically in the chat room live, same time. Usually Tuesdays and Thursdays. I'm in a lot longer than Monday, Wednesday, Friday, and that's just because I got to go see clients those days. But typically Monday, Wednesday, Friday, I'm live in chat. Let's see, 7:30 my time, so it was 8, 9, 10:30 to like 11 Eastern time. Tuesdays and Thursdays, I'm usually on for like an hour and a half, right around 10:30, 11 Eastern time. Okay, do I have to own? No, Dusty, you do not have to own the stock. I think that's only like covered calls. Do you know when to dump or roll if it's going against you like Apple did? Again, Ronald, I normally don't roll defined risk trades. Only undefined runs, which is usually strangles, are the ones that I roll. I usually just let the probabilities kick in on the defined risk ones. So like this Apple trade, it's acting kind of like Tesla is right now, and Tesla tested us for a while. Sorry, I'm gonna let the probabilities play in and see what happens. I need to check something. What is that trading at? All right. Okay. Yep. All right. So let's first go. How do I find a stock to do for credit spreads? Okay. Get that thing out of your nose. On when you Okay, you'll hear me talk about IV, and you can see it up on Tesla. I'm gonna throw up Qualcomm though. Right here, you see 84%. Now, when you do a credit spread, you want the options to be as expensive as possible because you are collecting money up front. So you want to be able to collect as much of that as you possibly can. So you want to have a high IV rank. That just the implied volatility is really high, and option premium is kind of up there. Usually that's around earnings or an event, something like that. Is what causes the IV to go up, and the option prices cost more. So when you're doing a credit spread, you want to receive as much premium as possible. And that's, the premium is the difference between the credit you got for shorting one and buying further out. Okay? So I will look through my just large pile of stocks that I have and see who's got the highest IV rank. And those will be the ones that go on my watch list. And then I kind of go down further and figure out which one I want. But ultimately, just starting off, you want to have a high IV underlying so that you can collect as much as possible. And then it's the opposite for a debit spread. You don't want to pay premium price when you're doing a debit spread. You want to pay as cheap as possible, so you want to have stocks whose IV rank is something more like 9%, as you can see, or 0. Lowe's right now is trading at a 0 IV. So those are going to be cheaper than if Lowe's was trading with an IV rank of like 80. Okay? So that's like the first thing that I look for is a high IV underlying. And then at that point, I weed it down based on earnings, sometimes chart patterns, stuff like that. Okay, but that's pretty much how I find a stock, is just looking for the high IV, make sure there's no earnings unless it's an earnings trade, and going down from there. So, the problem there's one reason is, sorry, back up. One reason I like Tasty is they show the IV rank. Thinkorswim, you have to have a script, I believe, to find somewhat IV that is similar to what Tasty has. So it's a little bit harder outside of Tastyworks to find stocks with a high IV. But I do have a script that I could show you guys. What does the pop mean? Okay, that's kind of a Tasty trade thing. It's the pop stands for percent of profit, and that is the chance of making 1 penny or more by expiration date. And then the P50 is the percent of making 50% of the profit before expiration date. Okay. And why do I close at 50%? That's just my personal goal, is getting 50%. Just because of the decay, the timeline, you're out of the money, you can shoot for about 50% of max profit. Now, on debit spreads, I usually go 25%, only because that's more of a directional trade. You have to be right. And if it goes good for you, and then the next day stock goes down, then you're all the way back down to 0 again. So I like to just get out at 20-25% on debit spreads, but credit spreads, I usually shoot for about 50%. Okay. So let's see. I got some notes here. Different types of spreads. Okay. What is we got? I think I touched on theta. So theta is, you know, your decay over time, and when your options are out of the money, they decay faster than options that are in the money or at the money. So this is why we go out of the money. And how far out of the money do you go? Typically, I shoot to get about 1/3 the width of the strikes. So if it's a dollar wide vertical spread, I want to get like 30 cents. You know, it doesn't have to be exact, but I don't think I usually do not go low than a quarter. So anything more for me, anything more than a quarter is pretty good per dollar. So if I'm doing a $2 wide, I need to get at least 50 cents. You know, $3, I got to get at least 75 cents, and so forth. So, which usually runs you right around the 30 delta. Okay, so let's find one that I can show that has. So what I mean by that is I start, you know, right around 30 delta, and on a dollar wide, so this 58 and 57, I would like to see 30 cents, you know, ideally. And this dollar wide is only 22 cents. So to me, that's below the 25. I wouldn't consider that type of trade. You'd have to go up a little bit further to try to get your dollar. So right there, you could do 58 and a half, 57 and a half, get your 1/3. But that's just me. Again, it's preference. I mean, the further away you go, the more your probability increases, but the less you're going to take in. And if you're trading anywhere but Tastyworks, odds are you're paying a base fee and a contract fee. And it's not going to do you any good to collect something, you know, 20 cents, because you're already what, 5, 10 plus a couple of bucks, so you're only going to make half of whatever you collect on it. So you know, if I collected this just for the instance here, that's $30. If you did it one contract, you buy it and sell it, you know, at 50%, that's only $15. If your commissions are you know, $5 in plus $1 for the contracts, I mean, you're looking at $12. You'd only make $3 on that trade. So you got to take that into consideration to make it profitable. That's another reason why 50% is good, especially for people outside of Tastyworks. Joseph, commissions on options are $1 to enter, 0 to exit, with the exception of some indexes. And then there's a cap as well. I could place 100 vertical spreads like this, and it's only going to cost me $20. And then when I close them out, I don't pay anything other than the, you know, the required tiny fees. So you got to try to get your commissions just like normal. You want to get your commissions as low as possible. Okay. Yeah, I'll share that. What I'll do is I'll have that link posted in the video comments when it gets posted. Okay. Yeah, you want to get your commissions down. Where to go? Expirations. Okay, that's the next thing that you want to look for. Other than the obvious 30 delta roughly, you want to buy, or you want to place your trade at about 30 to 45 days to expiration. Babe? There's someone at the door. Sorry.
Oh my god. It's okay, it's my fault. I forgot to tell you.
What happened?
It's our sign. It's Thursday.
Oh, it is, isn't it? Sorry.
Sorry, bud.
Forgot to pick up her kid at school. You want to do 30 to 45 days. Why? again, that's ultimately up to you. If you want to do 7 days out, by all means, go for it. But you have no room for error. So going 30 to 45 days gives you room if you're wrong. For one, it could play back out. And we can, again, use Tesla as that example. It went up, it tested, it went in the money, and then over time it went down, and we sold it today for 50%. So, and that was like an 18-day trade, I think. We were in that trade for 17 days. So, if you were in only 7 days, even 15 days, you would have lost. Or you may have made it, but you got very little room for error. So 30 to 45 days to expiration gives you plenty of time for that theta to kick in. It gives you time for the trade to correct itself. And then you usually try to be out before 21 days. Roll it if you're undefined. There's a bunch of things, but the 30 to 45 days is my ideal and my recommendation on doing it. Sometimes, seriously, dude?
Yeah.
Sorry. Sometimes I'll do like 25 days. Like if there was if you only had 36 here, and then if it was only quarterlies, and the next one was 22 days, I would sometimes place it, especially if it's like 29, 25 days, and then the next one's not till 50. I'll sometimes go 20 days to it, but typically it's 30 to 45 days. Okay, that just, like I said, time to play out, time if you're wrong, that sort of thing. Okay. Correct, Mario. You want to try to get 33%. That's mainly, it's obviously it's 1/3 the risk width of the spread, but it's there to give you a decent risk to reward, as well as make the trade worthwhile on your commissions and the days you're in the trade, that sort of thing. You don't want to get less than that, and you're not making any money because your commissions are eating it up. So 1/3 of the width is pretty good. It gives you a decent 2-to-1 risk to reward. And yeah, but I said I'll go down to a quarter, but that's the most I'm willing to, or least I'm willing to take on it. Okay. Let's see. We did expirations. We did where. What else was there? Okay. So, how do you place these trades, right? I'm going to do Tasty first because it's really easy, and then I'll jump over to Thinkorswim. Sorry. That's another good question, Dusty. It doesn't, but you want liquidity. Okay? And let me touch on that too. What do I mean by liquidity? You want a decent amount of open interest on here. If you see, I've opened up a weekly on Tesla, right? And it just, there's not a lot of open interest, 90, 20, down here, you maybe got 100. So it's not very liquid. There's not a lot of people wanting to place this trade on a weekly. Now, you jump down to a quarterly and you're in the thousands. So the more you have on open interest, the easier it is to get in and get out of the trade. So you want to try to have liquidity in it. So while you can do weeklies, make sure there's enough liquidity that you can get out of the trade if something goes against you. I mean, because you can get in it. You can drop it down far enough that you eventually get in it on a low liquid weekly. But you don't want to have it too low that you can't get back out. Right? You want there to be somebody who's willing to buy it back. Okay. Now, we can use SPY because that thing is just really liquid. And all these weeklies, you got the main, it looks like, some of these have quite a lot of open interest on them. Well, that one has none. But you could see like the April 15th weekly, that has a ton of liquidity in it. So you just want to have a lot of liquidity. It's another reason why I like Tasty as well. It also tells you if the stock in general is liquid enough. And they have like a 5-star thing. You can see their liquidity here. SPY is 5 stars out of 5 stars. So you're pretty much going to get in and get out. But there are some, like Lyft, they say doesn't have a lot of liquidity, okay, overall, which kind of pans out. If you look at even their quarterly, very few have that much in it. So yes, Joseph, try to shoot for over 100. That'll at least get you in and out without having to drop your price to get in. Okay. Sorry. All right. So, how do you place these trades? I'm just gonna use SPY so I don't have any confusion. All right, so say you wanted to, you're on Tastyworks and you want to place a vertical spread on SPY, thinking that it's gonna go up. Give me a second, Mario. So say you think SPY is just gonna go up. It's gonna go up over the next couple of days. So you're wanting to be long this this particular ETF, right? So looking at it here, you would want to look, we're going to pretend the IV's high, okay? So say SPY had 50 rank, even a 40, okay? So it's fairly high. You want to try to find 30 to 45 days, so this weekly's perfect at 36. So you take like the May 17th, right? Open that up, and if you thought SPY was going to go up, then you want to be short on the put side. So you look for the 30 delta first to just see where you're sitting with it, right? So you're going to short the 30 delta one, which is going to be this 283, okay? Sell to open, the 283 strike. And that's giving you 219 is mid price right now, okay? Then you need to cover yourself, make this a defined risk trade. So you're going to want to buy further out of the money. In this case, you can go for as cheap as possible, buy the next strike down, the 282. And as you can see, it's fairly cheap to place this trade. Okay. And it only gives a 19-cent credit. It's not 1/3 the width of the strike, but it also has a very low IV. Who's got a higher IV that we can show this on? Perfect. Okay. AMD. So, just like I said, short one strike and then buy the next one below it. Okay. This has a fairly high IV. I'm going to touch back on that. I will do a credit spread on any stock or any underlying all the way down to probably a 30 IV. Obviously, I want higher, but lately it's been 30 to 50. Anything higher than that, you've been lucky. So 40 isn't too bad. So assuming you liked AMD and you thought it was going to go up, then like I said, you want to find 30 to 45 days. Now you have your option of a 29-day all the way down to, say, the 43-day. But looking at it, there's not a lot of liquidity here. You could do it if you wanted to go 30 days. Diversify yourself a little bit too and put multiple positions in. But doing a quarterly, you're going to have way more open interest. So again, if we thought AMD would go up, then you want to go ahead and short. Just start off seeing where you're at. Short the 30 delta, which is going to be a 25 strike, okay, out of the money. And then buy further out of the money the 24 strike, okay. This, as you can see, gives about 28-cent credit. So it's not quite 1/3 the width, but it is right around that spot that I'd be willing to take. And you could try to bump it up to 30 cents just below the ask and see if you're going to get hit or not. But so that's not too bad. So that's how you would place a $1 wide vertical spread, thinking that, hoping that AMD is going to go up or at least stay where it's at for a couple of days here. All right, and that would give roughly 1/3. Say you did 30. Okay, so by 1/3 the width, that means your max loss is only going to be $70, and your max profit is going to be 30. A width would be $1 wide, Jonathan. So as you can see here, 25 and 24, that your width is $1. Okay, so you want to collect, 1/3 the width would be 33 cents, but I'll go about 30 typically, all the way down to 25. So if you're collecting 30 cents on this trade, then that means your max loss is 70. Okay, because it's $1 wide. The most you could make on the trade is $1 or $100. Okay, well, you're collecting 30 up front, that leaves you 70. So you have about a 70% chance that this is going to be profitable for you. And as you can see, Tasty says the pop is about 69, so close enough, right? But Tasty is also saying that this particular trade, you have a 75% chance of making half that money back before expiration date. Okay. Now, I like to go about $3 wide, all the way up to $5 wide. A couple of reasons why I do that is, okay, you have $1 wide. That's only, $28. A lot of you might want to, drop, a lot more, contracts down to make it a more reasonable trade. But that's putting you at 10 contracts to make that much money, whereas you could just widen your strikes, and one, it's going to get it similar to having 2 contracts, and 2, it also makes your break-even point a little bit further. So like this $2 wide one, it's almost, not quite, but almost the double the profit as if you were $1. From 28 to 51 is a little bit better, and you save yourself contract, right? And you jump it down to 3, it gets a little bit worse just because this isn't as high. But you could see also here, this green line, the further away from your short strike you go, the better your break even is. So at $1 wide, your break even is pretty much, I can't even get to it. It won't let me. There we go. 24.72, right, on $1 wide. That just means at expiration date, to break even, the stock would need to close at 24.72. Okay, but the further out you put your strikes, it drops down just a tad more. Okay, so by going $3 wide, your break even is right around 24.30. So the wider the better, and less amount of contracts you have to put down. So that's really good for you guys. It also raises your probability by going $3 wide. This jumped it up a couple of more percents overall, and $5 more chance, on collecting 50%. Okay. Oh, sorry, I guess on my eye. So that's how you place a trade for a vertical spread in Tasty Works. You always just go out of the money again, right? Short out of the money, 30 delta, and then buy your hedge one or more strikes down to create the defined risk. So this is your vertical spread. This is you thinking AMD is going to trade either where it's at or higher. And again, this can go all the way down to 25 before you're at a loss by expiration. Okay, I got to put that out, because a lot of the times we get into a trade and, right away the trade's negative. Well, why am I upside down 5%? And that's just because the stock's moving up or down, pennies, a quarter, whatever. So the option price is going to change. So until theta kicks in, it's going to be negative. All right. So, but you could be wrong. With AMD trading at 27.80, you got $2.80 before you really have to worry, and even then you don't have to worry too much unless it's a day before expiration. All right, so that's what I mean by you can be wrong I could be wrong by $2 on this trade and still be right in 36 days. I'll still make max profit. Okay. So that's your vertical spread. Your iron condor is the exact same thing, just doing both sides. So after you've placed your put side, you're going to go in and do the same thing on the call side. And now you have a range that you want AMD to stay in. So if you thought it was just going to go sideways, now then the iron condor is what you want to place. All right. You still want to get 1/3 the width of the strike. So at $2 wide, you want to try to get, what is that? What's 1/3 of $2? I can't even think of that right now. $2 wide would be 60 cents, right? Something like that. So this is close to it. All right. I mean, you can be directional on an iron condor, but it's still neutral. And what I mean by that is you have to like go at the money with one. And if you thought AMD would go up but still not be too crazy, you can go at the money and further out of the money. And now it's kind of a directional based iron condor. Okay? So that is how to place those two trades in Tastyworks. Anybody got any questions? Correct, Mike. So, on an iron condor, you're paying, well, at least here, I would be paying $4 in, $0 out. Now, say you're with TD Ameritrade, you pay the base pay. I don't know what. Just say it's $4.95, but then you pay your per contract. So you're at $1, so you pay $4.95 plus $4 more. You're sitting at what, $8, $9. And then close it again is another $9. Okay, but Tastyworks, this would cost me $4 to get in. Okay, I'll show you. So it would cost me $4 to get in, and then 58 cents for the mandatory fees. But then if I were to close this position, the commissions would say 0, and it would cost just the 58 cents. So this total trade in and out is going to cost what, $6.16 in and out. Okay. Account size and trade size. Yeah, let me go back up. Mario, how much risk to put into a trade? That is ultimately up to you and how much you're willing to risk of your portfolio. I try not to put more than 5% into any trade. That way you're not risking it all onto one. Okay? So if this trade goes wrong, you still have 95% of your account to work with. But it's ultimately up to you, whatever you feel comfortable with. But like on a 10K account, I mean, that's what I'm trading with is roughly 10,000 right now. And I'll do anywhere between 1 and 5 contracts. But I'll put about $1,500 max into any trade. So is that 10%? That's 10%. But that's about max is what I'll do. I try to go maybe $500, $600, $700. But it depends on the buying power. Strangles require a lot more. But 1 to 5 contracts is what I put in. But I trade small, trade often. I mean, if you look, I have quite a lot of open positions. That just kind of gets me out there and open. So I don't recommend putting a lot in, especially if you're learning. Do 1 contract just to get the hang of it. So Joseph, account size and trade. Again, technically you can do this with $500. Some brokers will not allow you to do any spread trading with anything less than $2,000. So you have to double check. But with Tasty Trade, you could trade it with whatever it costs. Like here, $38. If that's all you have, if you had $50 in your account, you could place this trade. But I know like Trade Station, you have to have $2,000 in your account. So you just gotta see who you're with. I'm not sure if Thinkorswim makes it that you have to have 2,000 in there. But yeah, I mean, you could do this with $500. On that note, I'm going to be doing next month, May 1st. I'm starting a small account challenge on spreads. I know I got a lot of different things going on right now, but I'm gonna show that you can trade with $500, but you're going to be doing one trade at a time. So if you were, had only $500, you could do one trade, maybe two, and show you how to grow an account with that. So you can have $500, but I think it's only with Tastyworks because they don't require a minimum. Okay. Let's see. Size trade did that. Can you explain direction Condor a little bit more? Yeah. Okay. So again, if you really think AMD is going to move upwards, you want to do a vertical spread, right? Because that means just as long as it goes up, you make money. But if you wanted it to cost a little less, you could do an iron Condor. But if you still thought that, okay, well, I think AMD is going to go up, but I think it's going to maybe hit resistance, it's going to stop and not really go down but trade sideways, you can go directionally on that. So if you thought it was going to go up and you still want to do an iron Condor instead of a vertical, then do a vertical spread at the money, right? So say you did a vertical put spread at the money on AMD, right? And then go further out of the money. Instead of a 30 delta, maybe go down to a 25. Now you can see that it's a little bit more directional based, meaning now, what was that, like 26 and change all the way up to 32 and change. It's not centered anymore. As you can see here, the stock is trending at the low end right now. If you thought it was going to move up over the next couple of days and then settle about here, you could do a directional based iron Condor. I have done that on an earnings play for some people as well, because they can't do strangles, and it worked out just fine. So you can be directionally based on it. I mean, you can go even further out of the money if you really wanted to and be really directional on it. But so that's like a directional based iron Condor, okay? Okay, a question about a good guideline for risk. Okay, we just went over that. Do you know what the brown ruler is? Yes, Edwin. Okay, this brown ruler right here that you see is the expected range during this cycle here. So anywhere between now and May 17th, their statistics state that AMD most likely will move plus or minus $4. That's what you can see all the way over here, $397. So between now and May 17th, AMD may go down $4, may go up $4. Okay, so that's what that is. That's the expected range for that expiration. And if you look, here, it's a little bit smaller. The expected range in the next 7-day cycle is only $1.25. Okay, so that's what the brown ruler is here. Michael, is this a real trade? I'm not placing a real trade. I was just showing it an example of how to place the trade. Okay, Rick, if you closed it in 2 legs, would each commission still be 0? Yes. Okay, we'll go to Trip. Let me just open this one today. So, if you were in a trade, you could close them individually. However, you need to have a much larger account, because if you were to close your long side first, right, you could do that, but it's going to reduce your margin even more now because you're short, you're naked now. So that is one reason why I don't leg out, because a lot of these options that I do trade are, you know, $100 or more, and to be naked is going to cost $2,000 or $3,000 of margin. So you can close out one side, leave it open, but you won't. If you don't have the margin, it won't let you do it. So that's one reason of just close them both out at the same time, and shoot for mid price. Okay, if you try to like scalp it and get, you know, the better price when it was, you know, really high, and you sell the long option, and then you wait for it to go down and try to get it here. Once you sell off that long option, you need to have whatever buying power available to cover you for the short option until you sold it. So that's why I don't sell one and then the other. Okay. Michael, I do have a referral code. For those that want it, please PM me and I will get it to you. I would greatly appreciate it if you do switch to Tastyworks, if you could use it. Now, if you are anywhere but the US, you cannot get it. Tastyworks is not in Canada yet, and they are working with Australian government or whatever that is to get set up in Australia. So for now, you need to be US citizen. How many different positions do I carry at once? Paul, I think yesterday I had 35 open positions. I closed a few out today, but opened more. I have 1, 2, 3, 4, 5, 6, 7. I have 24 right now. So doing spreads, it is easier to manage a lot more open positions than when you're just day trading stocks, because you don't have to watch these all day. So you can enter a bunch of trades and just monitor them, put your sell order in, and just kind of watch it. So it's easier to do a lot more. That's why I trade small trade often. I go through a lot more, and I close them out every day, and still collected a reasonable amount of profit. Okay. Yes, Ben, you need a margin account to do spreads. Now, you can, at least in Tasty Trade, do some defined risk trades on a cash account, but it's going to cost you above and beyond your defined risk. Okay? What I mean by that, I think I have a cash account with these guys somewhere. I don't know where it's at right now. I checked it the other day. Like this trade right here. This is all I need. It's $397 in a margin account. But if this was a cash account, I think it's double or more. So you can do some defined risks, at least in Tasty Trade, in a cash account. But I don't recommend it. A margin account all the way. You don't have to worry about PDT because 99% of the time we're not getting out of the same trade that day. Okay? But if you trade stocks and options, you might want to have 2 different accounts. It just depends on your trading style, if you're above 25K or not. Okay? Pat, no, they do not have a paper trading account yet. I did hear that they were working on it, but they don't. So I would recommend Thinkorswim. They have a great paper trading account. I know E-Trade just came up with one as well. Edwin, 1 standard deviation. Tasty Trade shows it for you. It is roughly the 16 delta. You could see it here. This blue dotted line is 1 standard deviation. This one is 2. Okay, so usually the 16 delta is 1 standard deviation. All right, usually, because you can see here it's not, but here it is. How do you manage that many positions? I let the probabilities kick in, Mario. I can have 50 trades open, and I just kind of check them out, 2 or 3 times during the day. I put my order in, and then I immediately go in and place my 50%, my 30%, whatever I want to get on that trade. I go and place it right away. That way, I sleep in, I'm gone, I'm doing something, and I can't monitor it. If I have my order in and it hits 50%, it's going to sell. Okay? That's how I can kind of get away with it. Set up Tasty Trade. I have not, but that's kind of what we're doing here today too. So if you have any questions on how to set it up, let me know, and I can kind of walk you through some of that. But Tasty Trade is very basic on their setup. You could see here you can only have 2 extra columns on your options chain, because you can't change the bid or ask, but you can change these 2 columns here into anything you want that they have available. I like to do delta and open interest, but I also switch down to out of the money. But delta kind of gives me that as well, so I don't really need that. Okay. Okay, let's see. Sorry, guys, work. Let's see. Regarding liquidity, if 100 of us go in one trade, maybe me and you are 100, could that be problematic? Well, open interest, that's how many people currently have trades. So if you go in, if 100 people now go in, and you're waiting to be filled, that open interest will go from 100 to 200, assuming you're above what they're wanting to be filled on. But no, it shouldn't be too problematic. But again, I usually shoot for in the thousands where it's not really a problem at all. My indicators for leaving before 50%. Good question. If I got into a trade today and tomorrow it was up 30%, I would get out. Because it moved that fast, that quick, I'm not going to give up 30% for another 20. So I'll get out early up to a certain date. Like within the first 5 days, if I'm up 30 or 40%, I'm going to get out. Because I don't want something to happen over the next 25 more days and I lose that money now. And now I got to wait 15 more days for it to go back up. So I'll get out prior to 50% if it's currently up, 30% or more within 1 to 5 days. I'll also get out before if it's just been dragging its feet. If I'm, 25 days into it and it's only at like 15%, I'm just going to get out because it's wasting my capital. And I did that with a strangle yesterday, I think. I was in it for too long. Okay. I only saw a couple alerts from you. I'm guessing you don't alert. I do alert all of my trades, Mario. I only place 1 to 3 trades a day. Sometimes I don't place a trade if I can't find one. So I'll post them in chat and they'll go out on email. I do not place stop losses, Rick. The defined risk ones I don't even worry about. The strangles that are undefined I will watch carefully, but I don't place a stop loss. Tasty really doesn't have a stop loss, but I don't want to do that. It's kind of mentally. Yes, Paul. Right now the put side has been more. Couple of reasons. 1, puts have been more expensive than the call side, and 2, we're still kind of in a bull market. Even if stock's going down, it ends up turning around and going right back up again. So puts sell for more, and we're still kind of bullish in the market right now. So I've been selling a lot of puts. But as soon as this market tanks, if it ever does tank, you'll see me on the call side. Okay. correct, Edwin. So again, this trade right here, the max I can make is $103. So when I say 30 to 50% profit, that is 50% of this max amount. So if we got $1 on the trade, 50% would be $50. So that's how much you get to keep. You sold it for $1, and I'm looking to buy it back at 50 cents. And now I just made 50% profit on that trade. Okay? So that's what I mean by that. Michael, yes, their commissions are one of the best things. It took me a little bit to get a hang of their platform. They don't have the greatest charting. That is why I have 18 million windows of Thinkorswim open. But Tasty Trade is not they're not a big technical analysis on their what they do. They are probability traders. So they created a probability platform. That's why Tasty Trade does not have level 2. You could day trade all you want on it, but there's no level 2 for you to look at. Which is why I say if you're going to trade stocks, don't go to Tastywork. Because if you need that level 2, you need to have Thinkorswim open where it's free so that you can watch level 2 and trade. I mean, that's what I was doing when I was day trading for a while on SPY. I would have to have one open and go to the other side. Their charts are okay. I mean, as you can see, I use them just basic here with a daily chart. Excuse me. And I get the information I need because I just look at trend. I'm a probability trader for 99% of the trades. I just check to make sure I'm not making a stupid trade by the chart is clearly going in the other direction. But if RSI is, crazy and the crossover here and there and all this crap, I'm not going to be like, okay, well, I need to go short now. I'm going to check the probability because the probabilities have been more accurate than anything else. Can I place the close order at 50% anytime? Yeah, as long as you know, if you're not on Tastyworks and you're on Thinkorswim, which I'll get over to here in a second, you just need to know what the 50% part is. Tasty Trade, and you're not going to be able to see it. I'm going to show you. And I figured out how I can do it. Let's see. So you see here, right? I know you guys can see it. Okay. If I select these two trades, you can't see the new thing. But if I do this, you might be able to see it. Oh, man. Nope, I didn't do it because I had to move my mouse. Sorry, I was trying to show you it. There's a menu that pops up on Thinkorswim. Not Thinkorswim, Tastyworks. That says close for profit. So you can be 10%, 0, negative, and enter your 50% at any time. I mean, it could be at 60%, and you can enter it at 50, and it'll close at the best price. I just do it so I don't forget to do it. I do it right after entering. How am I establishing direction? Again, I'm not totally a technical trader, so I use the 3/8 on my charts because when I was day trading, swing trading, 3/8 have been good to me. So I put them on there just to see what's going on, but I don't totally go off of it. Say it was this day, right at the cross. I wouldn't say, all right, I need to get into a put spread because it's going up. I could short trip right now and still be right because I'd probably be shorting it way up here. And it can continue to rise and then drop back down. So I don't use the technicals too much. I just kind of use them to help me with the guide of what is the overall trend for that particular stock. Okay? All right. I'm going to jump over to Thinkorswim now because we are over an hour in, I think, here. So, hold on. sorry, we're 2 hours. Perfect. Okay. Perfect. Okay. My winning percent, Mike. Right now, hold on, I'll tell you. It's kind of hard. 80%. What's this one? 1%, 100% there. 70% there. I'm checking my trade journal. I have like 4 different tabs for each account. But I want to say I'm sitting probably, if I add all the two and average them up, I'm sitting about 80% profit. And the only reason why that's not that way is because I had to roll a strangle out, so it considered it as a loss. And I have a couple of day trades on here too. But I want to say I'm sitting at about 80% win rate. This week alone, I've closed out over 250% in profits just this week alone. So that's the other thing, guys. It's high probability trading. I mean, I shoot for at least a 65% pop, which again is a penny or more on expiration, and roughly 70% P50, because if it's about 75-80%, it's almost 100% chance that I'm going to get 50%. Okay. I usually will not trade if these are under 60 and under 70, 65, because it doesn't work. But there's a high probability trading. As long as it's done right and you have patience, it's going to be a profitable trade 80% of the time. Okay? So that's how you make the money, man. I don't know. It works for me. So let's go, before we drag this on too long, let me show you how to do these trades in Thinkorswim. Okay? This platform, some people probably already know it. Yeah, Rick, they have. Bed Bath & Beyond paid really good at 50% this morning. All right. So Thinkorswim. Okay, this is the platform on Thinkorswim. And I'm assuming most of you have already used it. You know how to place the trades. Okay, you go to the trade tab, brings up your options chain. Okay. Should look something like this, I'm assuming. Depending if you guys have the weeklies or not weeklies set on here. But again, okay, say you wanted to place a weekly trade, or not a weekly trade, excuse me, a quarterly trade in SPY. Okay, make sure you just go to your option chain and open up the weekly at 517. Okay, I like to have the same thing in my columns as I do on Tasty Trade. Okay, and you can change your layout right here, option chain, days expiration, single, your spread, and layout. And I don't know if this is custom or not. I think it's custom. I went customized and made mine. I have delta, probability out of the money, open interest. I don't know why implied volatility's there. But I like to see the deltas, I like to see the out of the money, and I like to see open interest. If I could have 3 columns on Tasty, these are the 3 I would have. Okay? Now, you can change your strikes, I'm assuming, right here to view all, or you can put in the amount you want to see. Sometimes on bigger underlines, you're going to have to expand it to all to see that 30 delta. Okay, but this time you don't have to. So, there are a couple of different ways to place a trade from the options chain. And we'll go just a straight vertical spread. So you can go here on this top columns area where it says spread. Most likely you have it on single if you've been using this to trade just longs. If you click on it, it'll give you all the options available. Okay. I absolutely hate this view. If I changed it to vertical, what it does is it changes, you can see the strikes to dollar-wide strikes. It just changed it to the next strike. I hate that. mainly because I don't trade dollar wide strikes. I usually trade $3 to $5. And if it's a dollar wide or 50-cent wide underlying, that's a pain in the butt because then you got to click it and then go change it. But that's one way you could do it if you're going to trade the next strike down, which is usually 50 cents or $1. Sometimes it's $5 if you're on bigger ones. Okay, so I like to keep this one as single. Now, if you're going to, the other way to do it is, okay, you want to do the 30 delta right here. If you hover over it, is it showing it? Good, it's showing it. You could see it says sell if you hover over the bid column. Okay, if you right click there, that'll bring up a menu, and you can see that good. And you go to sell, right, and it'll bring another menu up. Now you have those same options, but if you select vertical that way, it'll pre-do a dollar wide, the next strike down for you, and then you can go in and change it. So you see here's the one that you would have selected sell on, the 283s, you're short, the negative dollar here, and then it gives you the next one down, the next one out of the money, 282. Then you can click that and say you wanted to go to $2 wide, you'd have to change it to 281. And now you have your $2 wide, okay? And then it gives you the mid price, limit day, blah, 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 okay? So that is one way to do it. The way that I do it is just individually doing the legs. So again, you can just hover over the bid price on the one you want to sell first and click it, and it's going to bring up your sell, right? If you then hold down control and select say the 280, I want to go $3 wide, and click on the buy, it's going to give you it that way. All right, and you can tell this is a credit spread because it's red. If you did it wrong and you selected it but then you accidentally did it here above instead of below, it turns it green, and that makes it a debit spread. So that's how you know. If it's red, you're selling the position. If it's green, you're buying it. So, again, you select one leg and then select the other side. Now you have your vertical spread set up, and Tasty Trade should automatically populate it at the mid price. So mid price 51, 51, limit. Here you'd have to change it to good to cancel if you wanted to try to get in it longer than 1 day. And then you just go ahead and hit confirm and send. Now it doesn't give you the information that Tasty does. Here, you know what your break even is up front, right? They'll tell you that one, and how much you're going to make, what your max profit is, your max loss, the cost of the trade, and see, guys, what I mean by negotiate at TD Ameritrade. I only pay for contract size. I don't pay a base trade, so that's where I was trading before I went to Tasty Works. But I only pay $1.50 a contract with no base. So this would cost me $6 to get in and out. $6 to get in and out. But Tasty Trade only cost me $2. But negotiate your fees. There's no base pay, so I'm not paying, $8 or $9 to get in. But so it tells you your commissions and then the resulting of your buying power. It does not tell you your probabilities or anything like that. You'd have to try to calculate those yourself. That's how you do your trade there. Okay, fairly simple. If you want to do an iron condor, same thing. You could do it here, but I can't understand that. And I don't know if you can understand that, but I can't understand that. That's just it's too funky for me, and I don't want to mess with it. So that way I would just cross that completely out. You can do it this way, again, bring up the menu, but it's gonna give you where to put the calls at. 283. So you put them all in the 282, 281. I don't like it either, because then you got to go see where you're at and change it. So my personal preference is doing them automatically. So sell one, buy the other, and then go down to the 30 delta, sell one, and buy the other. Now you have your iron condor set up. Analyze tab. I've never used the Analyze tab on Thinkorswim. That's funny. Let's see. Probability analysis, I assume. Yeah, see, I don't even... You got one up on me on that one. Oh, man. Yeah, that's too much. Too much work. Tasty Trade is so much easier. Okay, so apparently there is a way to get your probabilities. But it looks like you have to do like a lot of work and create your trade. It might just be easier to use Tasty Trade. Okay, yeah, you can right click if you're in it. So you have to be in it though first, is what you're saying. Or can I do this? Oh. Are you guys saying like that? Look at that, I'm being... Where's the probabilities at? Out of the money. May 17th. Where's May 17th? Huh. I'll have to mess with that, I'm assuming. Looks pretty cool, but it's just... I'm sure it's really great. But, that's too much work when I can just have the trade up and know right away. So, alright, so that's how you do your trades. We're going to get back on track here before we get 2 hours long. So Thinkorswim, fairly simple the same way. You just select each leg just like you would on just like you would on Tastyworks. You select each leg. You know, your vertical spread, sell the first one, hold down control, buy the next one. There's your vertical. You want to do it over here, hold down control to get your third leg and your fourth leg. And now you have an iron condor. Okay? And you're good to go. So, that's it on Thinkorswim. I haven't used it in a while, so I don't know if there's any other really great features, but that would be how you would place them. I can get you that far on Thinkorswim. All right. I know. Ooh, I'm gonna have to get out of that stock. Somebody had a question back over for Tastyworks. Where was it? Can you show your position page setup again? Yeah, absolutely. So I like to see my capital requirements just to know how much money is being held for that particular trade. Okay, I have days open, which is just D open. Okay, and that is all blank unless you have it drop down. Then it'll tell you, I've been in EWZ Strangle for 9 days now. Okay. Indicators I have on just so I can keep track of how close earnings are getting or dividends. And then I have percent or P&L open percent, which will tell me the current percent P&L that I'm at, and that's what I pay attention to. I have P&L open. This just tells me what the current actual value is of it, which it doesn't really matter too much. I use it mainly to my $100 stop loss. And then I have P&L for the day. I just like to see if I'm up or down on the day, if it's going in the right direction or not. Okay. Cost. I don't think I just ever took it out. That was the initial price that I paid. I think this you could tell by $1.11. Is that what I paid for Apple? Yeah. Okay. So cost on a credit spread tells me what I received on this trade. All right. Mark is currently the mid price of the trade, and then you got intrinsic value, right? And then I have days to expiration, which again you have to drop down and open your positions to see I still have 36 more days in this trade, right? Theta I keep on here just to know what my daily theta is for those. And then I have pop to keep in line of if I'm still going to be profitable. And then I have IV rank so that I can just see if it's changed lately. Last you can't change. Okay, those are what I like to see. But if you, what was that? If you go to the little cog or whatever here, it'll bring up the settings tab. And the one thing about Tasty, no matter what spot you're on, it automatically displays to that section you're in. So here on your positions tab, here's what I have. Here are all the options I could still put in. Okay. Michael, one more please. One more what? What did you want to... Iron Condor on Thinkorswim? I assume? Yeah, okay. Alright. Okay. So, clear this out. Alright, so again, I like to start at the 30 delta because on an Iron Condor, all it is your vertical put spread and your vertical call spread. So again, I start at the 30 and work my way up or down from there. Okay, so looking at it here, we have the quarterly expiration up, and I always start on the put side. I don't know why, just kind of where I gravitate to. So looking at the third, babe, you might want to make sure that door's locked. Walter's out. Go to the 30 delta. So looking at it right about here, 283. Hover over the bid. It's going to tell you sell, right? So you go ahead and click it. Brings up your first order. I usually go $3 wide minimum, so that I need a touch on that too. Oh my gosh. Okay, $3 wide. So then I'll hold down control and I'll jump down to 281, hover over the ask, and it brings up the next leg. Okay, there's your vertical put spread. Then you jump over to the next side, look for the 30 delta again, so either one of these works just fine. Keep holding down control, hover over the bid, and it'll give you your sell. Go down to $3 wide and click the buy, and now you have your Iron Condor set up, and it'll tell you right here what you did. Make sure you have it on correctly. In the little left hand side it says Iron Condor. Okay, if we did just one side, it should tell you vertical. Okay, custom, and then once you change that, it's still custom, but that's a butterfly, so that's a whole another topic. For TOS, I use IV%. For IV rank, it's close, but not quite, Ben. I pulled up stocks like that, and I was like 20% off. So I'll get that script out. When I get it uploaded, I'll put that script so that you guys can copy and paste it. And let me show you. It goes on a chart. So unfortunately, let me pull up Tesla. So you see this right here at the bottom. It says IV 66, IV rank 38%, IV percentile 54%. Okay, if we bring up Tesla over here, it's gonna. You see this 34% right here, the IV rank. It's pretty damn close, 38% according to Tasty Trade or Tasty with According to Thinkorswim, it's 38%. According to Tasty Trade, it's 34%. It is very, very similar. Qualcomm is 84. Here it's 87. Before I found this script, it was all over the place. So I kind of just go through. You would have to maybe have a watch list in Thinkorswim, and then just have your linking going on, and then just kind of work your way. Let's see if I have that. Just kind of watch it and just go through your watch list to find ones that are high, and then you'd be able to tell that's low. Okay. For the most part, it should filter in for you. So, Ben, as long as it's over 35, 40, it's worth looking at lately. But yeah, if you can find something over 50, great. If it's even higher than that, even better. But again, the higher IV, the better, because you want it to be a very expensive premium. What was it that I was going to touch on? Crap, one of you said something, and it clicked in. Scan for IV. Somebody said something, and it made me remember something, and now I forgot. Shoot. All right. So that's what you'd want to do to get your IV rank. I've noticed in the scanning, I've had IV on there before, and it just did not work. And I don't know if you can add this script into the scan or not. I haven't really $3 spread or more. $3 spread or more. $3 spread or more. I did. Why did I say that? Crap. I don't know what. I'm sure it'll come to me after we're all said and done, guys. And we'll have to talk about it next time. Shoot. Spread difference. Are you trying to remind me, Steven, or is that a question? You remember something about nothing less than $3 spread up to 5. I did. Why? Why did I remember that? I thought I touched on it. Oh! I got it now. Okay. The wider your spreads are, the more the short confusing. The more the short is going to work better for you. And mainly what I mean by that is because if you have a short position that's $1 wide, dude, you're lucky you're not on camera. A child. Yeah, that script is going to be for Thinkorswim. I may have to do a second video maybe and show you how to put it in if you guys don't know how to put the script in. But we're getting on 2 hours, guys. We got to finish up here. Told you it was going to be long. I can keep going for another hour. If you only have $1 wide, right? And it's going to take a lot more movement in the underlying for it to work for you. Like even if you're $1 wide vertical spread and the stocks.
Mommy, can I go out with Mommy and Miss Sharon?
Are they out back?
No, they're out front.
Then you need to ask her. Open the window and ask her.
Okay.
Okay. $1 wide on a vertical spread, you need it, if the stock starts moving, great, you're gonna make money off of it, right? Oh, Rick, you're killing me. But if it moved a lot, great, you're making money. But if it didn't move that much, then it's not going to do anything because you've got that long option behind your short that's stopping it. Okay? So on verticals, I don't make too much of a big deal about it because I'm already assuming it's going to go up. But if you can separate, that's a bad one to use. Okay, if you can afford to make this width more, it's going to act more like a naked option. Okay, that's why I tell people when I'm doing a strangle and you guys you don't have the options approval to do naked puts and calls, what I tell you to do is try to do at least a $5 wide iron condor, because the further away you are from that short strike, the more that your play is going to act like a naked option. So when I'm over here doing, a strangle, right? And you guys can't do this, or some of you can't do that. I say go at least $5, because by going at least $5, you're further away from this short strike. So if there is movement, it won't be just like a strangle, but it'll act somewhat like it. That's why I call it synthetic strangle. It'll somewhat act like it. And the further, if you can afford to go even further away, even better. I mean, the further away from your short strike, the better. It's going to move better. So if you wanted to be just short, because you thought it was going down and you wanted to be just short a call, well, you can't because it's undefined. If you can afford it and go further out, this will act a lot more like you were a short call than if you were up here. Okay? So that's why, I mean, the wider the spread, the better. That's why I always do, not always, I try to do at least $3. $3 to $5 wide. That way, you got a little bit more movement wiggle room. So that's what I mean by it. Okay? So when I do iron condors, you want to try to at least do $3 to see profit. Otherwise, if you're a dollar wide iron condor, you're going to be in it for a while because it's really not going to do anything unless you have a sudden change in IV. You know, if the IV was at 80 and IV the next day dropped down to 20, well, hell, you'll be profitable. But so that's why if you can expand your width, the better. And it saves you from having to go contract too. You know, here it's $64, but if you can afford to expand it, it's still one contract, but now it raised, you know, you went from 36 to 100 with just a $4 wide one. Okay? And it's the same, saving you contracts going 144,
No crying.
but once you minus $8 off, and if you guys are on anywhere but Tasty where you got to pay $8 more, you know, it's better to widen it out. Okay, you get advantages on commission, and it's going to act more like your naked option. Okay, that was what I wanted to get at. So I think we are good, guys. Anyone got any questions on the platforms, Thinkorswim or Tasty Trade? Anything about the basics of the spreads before I cut you out here and redo another one? IV link. It's a long code, so I'm going to put it in the comment section of this video when we get it posted. Okay? So it'll probably be posted tonight or first thing in the morning. It's already 6 o'clock, and Jeff's probably a no-go to get it posted. So it'll be either late tonight or tomorrow that this bootcamp will be posted. The link will be in there. Okay? Those that PM to me, I'm going to send you the message for that referral. I greatly appreciate that.
Who is it, Mom?
It's probably Logan.
Oh. Okay.
Does a link on both Tasty Trade? I only have the referral on Tasty Trade. How did I learn these strategies? A lot of money in trial and error, and then also Tasty Trade. Once I started getting the hang of it, I started watching their streams. They do a live broadcast during trading hours. Why didn't that log me in? What's going on? And they have a big lessons. So you can go to tastytrade.com/learn or something like that, and you will. They have a lot of videos on every type of trade possible. So I use that to kind of define more the type of trading that I do. But I mean, a lot of my trading style is like them, but it's also different as well. All right, I messaged you, Michael and Jonathan. Shayna, I'm gonna post it in the video. All right, guys. Is that it? Let's see. Yeah, Gerald. I have to PM it. Thank you. Great lesson, great lesson. Thank you, thank you, thank you, thank you, thank you. Tasty Works was the minimum. Pat, you can open it with 0. You can open it with 0. You can get in there. You can check it all out, see how it works, and then like I said earlier, unlike other brokers who I think the minimum is 2,000, you could put $50 in here and find a trade, a defined risk trade that costs no more than $50 plus commission, and you can enter it. So, yeah. All right. How do I PM you? Just like this, Pat. Just click on the name. Okay. You click on anybody's name and it opens a private message box. Thank you, Rick. We'll do another in-depth one. I mean, I didn't even touch on strangles and butterflies and jade lizards and all that other stuff. Those are a little bit more advanced. I just want to get you guys the basics of these two right now. Okay? So I'm going to stop this recording now. They're going to hate me. It was so long. Thank you for your time. And I'll see you guys in the morning.